I spent the last 2 weeks reading reports on every major financial crisis from the last 100 years: 1929, 1987, 2000, 2008, 2020, 5 different decades, 5 different presidents, 5 completely different causes. At least that's how the news presents it. And when I finished, I had one realization that ruined my sleep for a week. They all started the same way. Not similar, not roughly, the same. The exact same set of signals, repeating like a broken record every single time the economy was about to collapse. And here's the worst part. That same signal is happening right now. Give me 10 minutes, and I'll show you the pattern that 95% of people reading financial news completely miss. Before we go further, I'm not predicting crises by reading tea leaves. I went through Federal Reserve reports, academic papers on economic history, and congressional hearing transcripts after every major crash. All in, it took me around 50 hours over 2 weeks. I'm not going to tell you to buy gold or sell everything now. This video is not financial advice. This is a video about recognizing a pattern that the industry doesn't want you to notice, because your panic is profitable for them. Let's start with the most famous one, the Great Depression. Before the crash of 1929, the U.S. economy looked unstoppable. The stock market had been climbing almost nonstop for 6 straight years. Newspapers were writing that a new era had arrived, one without crises. People were taking out loans to buy stocks. No savings, no reserves, just because the market only went up, and it seemed insane not to participate. By 1929, nearly 40% of all stock purchases were made with borrowed money. On October 29th, the market dropped 12% in a single day. But the real disaster didn't happen that day. It happened over the next 3 years, as banks began collapsing en masse because too many people couldn't pay back what they'd borrowed. Remember this combination? Euphoria plus borrowed money plus the feeling that this time it's different. Let's jump forward 70 years. The dot-com bubble, late 90s. The internet is the future, and everyone knows it. Any company that slapped .com onto its name automatically doubled in value. Pets.com, a company selling pet food online, was valued at $300 million with zero profit. Just because investors were convinced. This time it's different. The internet changes everything. People were taking out home equity loans to invest in internet stocks. Day traders were quitting their jobs because they were making more from stocks than from their salaries. In March 2000, the NASDAQ index crashed 78% over 2 years. Pets.com went bankrupt 9 months after going public. Same ingredient, euphoria, borrowed money. This time it's different. 2008. This one you probably remember firsthand. U.S. housing prices had risen every single year for almost a decade. Everyone was certain real estate can't drop in value because houses aren't stocks, they're a real asset. Banks started issuing mortgages to people with no steady income, no ability to pay checks, under what were called ninja loans. No income, no job, no assets. Why? Because banks were confident housing prices would rise forever, meaning even if a borrower couldn't pay, the house could just be resold for more. In 2007, prices started falling. By 2008, the entire system collapsed because loans handed out based on that same certainty. This time it's different. turned out to be unrecoverable all at once. See the pattern yet? Okay, now let's put it all together. 1929 to 2000 to 2008, and even 2020, if you look closely at the meme stock and crypto boom of that period. Every single time, three identical ingredients appearing in the exact same order. First, a long period of growth that convinces people risk has disappeared, not decreased, disappeared entirely. Second, widespread use of borrowed money by ordinary people, not professional investors, ordinary people, to participate in that growth. Third, and this is the most important one, a phrase that repeats literally every time, in every era, in every language. This time it's different. Not low interest rates, not a specific industry, not bad government policy, the certainty that the old rules no longer apply. That's the one variable that repeats in every crisis over the last 100 years. And here's what should actually worry you. I'm not going to tell you exactly what's happening right now, because that would turn this video into a prediction instead of an analysis. But I want you to ask yourself 3 questions the next time you see a financial news story, an investment idea, or advice from some finance influencer. First, am I being told that this time it's different? Second, am I being encouraged to take on debt, leverage, or borrowed money to participate in something that can't possibly go down? Third, do I feel like not participating is a missed opportunity rather than reasonable caution? If the answer is yes to even one of these, you might be looking at the start of the same pattern that's repeated 5 times in the last 100 years. That doesn't mean a crisis is guaranteed. It means you're looking at the same conditions under which crises have happened before. The creepiest part of all this isn't that crises happen. Crises are part of how economies work. They've always happened, and they'll happen again. The creepiest part is that people say the exact same phrase right before every single crash. This time, it's different. And every single time, they're wrong. Not because they're stupid, but because euphoria is specifically designed to drown out common sense exactly when you need it most. I don't know when the next crisis will happen. Nobody knows for sure. Not even economists with the best models get it right consistently. But now you know which phrase to watch for. If you want to keep figuring out how money, markets, and the decisions that shape your financial future actually work, subscribe. It only gets more interesting from here.